Welcome to Phillip Futures Market Watch. I'm Joyce Liu, Investment Analyst with Phillip Futures. The global economic recovery has been a rather choppy one. Since the US Federal Reserve first announced reduction in monthly asset purchases, dollar strengthened close to 1%. Most emerging market currencies experienced some degree of depreciation. Asian and emerging market equities tumbled more than 7% on average, and pulled along with them even US equities. Although the Federal Reserve expressed confidence in the outlook of the economy, some high-profile earnings disappointments and weak economic data seem to hint at the vulnerability of the recovery. But even so, there are investment opportunities that investors can take advantage of. In US, the 2.3% overnight fall on 3rd February threatened the market that US equities may now be in the midst of a correction. Sentiments are divided as to whether it will be a small-scale retracement or a crisis-like correction. Fundamentally, economic and financial indicators are giving mixed signals, but technical analysis seem to be able to offer some light. The 5.9% decline in S&P 500 since mid-January is only a 38.2% retracement of the last uptrend from 24th June last year. The same happened 4 times during the same large uptrend that started in early 4th quarter of 2011. The first, second, and third retracements all ended at a 61.8% Fibonacci retracement level, and the last one ended at a 38.2% retracement level. This time, as long as prices do not retrace to below 1,560, the uptrend may resume. However, if prices drop below 1,560, then the market could be headed for a large longer-term correction in the likes of the 2008 financial crisis. To express the views of short-term retracement or longer-term correction, investors can consider short-selling S&P 500 futures. In China, the Shanghai Shenzhen Composite opened 0.6% lower today at about 2015 after a week-long Lunar New Year holiday. It soon rebounded above the opening price. Compared to most other Asian and emerging market economies, including more developed financial markets in Asia like Hang Seng and STI, China's stock market performance is rather stable in the most recent emerging market sell-off. Investors chose to seek anchorage in China as they took comfort in renminbi stability and capital controls, as well as the government's cautious ambition to clean up its financial and shadow banking sector. This may set the foundation for renewed interest in China's stock market for allocation of exposure to emerging markets. Thus, China's stock market may bottom out sooner than we had previously expected, with downside now likely to be limited to 1,950 on the Shanghai Shenzhen Composite Index. Retail investors in Singapore can express both bearish and bullish views in China's stock market by shorting and longing index futures such as FTSE China A50 Index on SGX or CES China 120 Index on Hong Kong Futures Exchange. For more details on S&P 500, China A50 and CES 120 Index futures, and information on the risks and returns of investing in stock index futures, please approach any representative from Phillip Futures for further discussion. Thank you for watching this week's Market Watch. I'm Joyce Liu from Phillip Futures. Tune in next week for more Market Watch videos.